So if you watch my previous video where I talk about Hamilton announcement that they announced on Friday, they're coming up with 3 new ETFs, and one of these ETFs is a bond ETF that we never had. This is the first Canada first covered call bond ETF that I'm going actually to talk in detail about this today in this video. And if you look at my other previous video, if you haven't seen that, just make sure you click the link up there. You'll be able to know details of those other funds that they announced. But here I can actually so Hamilton ETF announces a filing of final prospectus for Canada first cover call bond ETF and expansion of its suites of yield maximizer ETFs. So I made a video about that one, and then these were Hamilton US Bond Yield Maximizer, which is HBND, and Hamilton Technology Yield Maximizer QMax, and a Hamilton US Equity Yield Maximizer, which is SMAX. These two here, they won't come to the market soon. They will be coming in the fourth quarter, so it might be end of this year, by end of this year. But this one is coming next week, and because of that I decided to make a 2 video parts. So the first one is to describe what they're coming up with and what they're gonna have, and the second part of this video is actually deep dive on HBND. So if you stick around, you're gonna know what HBND has to offer you as a passive income investor. And if it's your first time, just make sure you subscribe, because on this channel I always talk about these type of cover call ETFs and any other ETFs that I think they're suitable for you to invest your money. And if you like my content, just make sure you give me a thumb up. So let's go to Hamilton US Bond Yield Maximizer ETF. The ticker symbol is HBND, and initial target yield is about 10%, which is pretty good for bonds. And we know most bonds right now in Canada, they don't offer any near 10%. Inflation being 5%, 4 to 6%. If you get 10% from bond, then that gives you a 4% above the inflation. So it's pretty good. I was so excited to see this. If we look at the highlight of this fund, right, a 10% initial target yield, monthly distribution, exposure to trusted US treasuries, active cover call strategy to increase monthly income and reduce volatility. Unlike bond, covered call premiums are generally taxed as a capital gains. So for investor who investing in tax sheltered accounts like a TFSA or RRSP, you really don't have to worry too much. And this is because you don't have a direct hassle of dealing with the tax consequences. But if you're investing in one of taxable accounts where you have to deal with the tax consequences on a year basis, then this is very important for you to have these type of funds that will make sure you have capital gain versus bond interest, which you tax on full amount of your tax rate. So option strategy actively managed by Nick Picard. I'm not sure 100% if that's how you pronounce his name, but this is a guy with over 25 years experience, specialized in options. This is the guy who's going to manage and oversee these 3 funds. Who this bond fund will be suitable for investors who are looking for a high monthly income combined with the strength of US government bonds. The tax efficient distribution, right? Because as they explain there, instead of they're gonna use a cover call ETF strategy, so instead of being an interest, it's gonna be type of different income. But that's something that you're gonna have to talk to your accountant if you're an investor who wants to invest in taxable account. And also it's kind of a hedged exposure to long-term US Treasury. So instead of you buying, like for example, directly using US dollar, buying using Vanguard for example, you can just invest in this one, and then of course your money will be hedged, and also reduce volatility from options strategy. The investment objective of HBND is to deliver attractive monthly income while providing exposure primarily to US treasuries, through a portfolio of bond exchange trade funds. So it's going to be fund of funds. They're going to use other funds, and we're going to look at those bond funds in detail. And then to supplement the distribution income earned on exchange traded fund holdings, mitigate the risk and reduce volatility, HBND will employ a cover call option writing programs. So not only they're going to invest in bond funds or bond ETF that is just going to follow its index, but also they're going to use those bonds that they invest in. They're gonna write call option on them to generate that high income. Each bond does not use leverage because Hamilton has used leverage in other funds in order to generate a high income, because you are using leverage to increase your margin profit, right? You to generate more income. But because this is a bond fund, meaning they don't want to have that, to expose it too much to more volatility, so they are going to not use leverage at all, because the whole game of bond is to make sure your portfolio doesn't have that much volatility. That's why that's a decision that they decided not to use leverage. But still, you get a 10% on bond. That's a huge initial target yield will be 10%, and that's initial, meaning so if the bond falls, if the stock price of that bond or HBND falls, of course this yield will increase, as we've seen on from other ETFs that they had before. And BND is designed for investors looking to maximize their monthly income above what is typically offered by bonds. We've discussed about that, because regular bond will only give you about 3 to 4% right now, but this one will give you about 10% and more, so that's pretty good. With exposure to trusted US treasuries and active covered call strategy, hedge bond combine strength and the security of US government bond with higher income and tax efficiency of covered calls. And we've discussed about that. US treasuries being one of the most secure bonds you can have for any government in the world. Of course, if you invest in Argentina, you know, Argentina bonds are always default. There's a lot of higher yield bonds, for example, in a country like a Turkey. But of course, those countries, they always have sometimes default, and you're going to lose all your money. But with this one, of course, it's a US. We look at this US strength. I don't think it's going anywhere anytime soon. With HBND, we take an income first approach, selling call option on roughly 50% of the portfolio, using at-the-money contracts which offer higher premiums while maintaining 50% upside exposure. So same like any other of their other previous ETFs that we've discussed before, they're going only to write calls on 50%. So you're going to use 50% of your portfolio to write call options, right? While they leave the other ones and just exposure to those bonds, underlying bond that they invest in. I really like this strategy because you don't have that risk of 100% exposure to, to options. So it's a pretty good strategy. I like what Hamilton is doing, to be honest. So now let's look at overview. So treasury term. So the term is the duration of the bond, how long the bond, how long those bonds, underlying bonds, are invested. So there is there are 3 terms here. So there's a long-term bond, which is 80% of the portfolio will be subject to long-term bonds. Medium-term bond will only be 10%, and short-term bond will only be 10% as well. So we know majority of portfolio will be long-term treasury bond. We look at the holdings here. This will be fund of fund. Fund of fund meaning is a fund that invests in other funds, right? Because there are 2 types of funds. There's a fund that invest in direct stock. So meaning, for example, S&P 500 would have just, like Apple, Microsoft and stuff. They invest directly in those stocks. Other funds like HYLD, for example, it's a fund that invests in other funds, right? So indirectly investing. This is strategy that Hamilton uses a lot, and a lot of ETF managers use this strategy because it's a very simple way to have exposure and diversification of different sectors without having to go and buy individual stocks. So we look at the holding here. The first one is iShare 20 plus year treasury bond, which is a 50%. 50% of the portfolio will be in a very, very long 20 plus years, right? So the second one will be a Vanguard long-term treasury, 30%, and we'll look at the third one will be Vanguard intermediate term treasury, 10%. We have SCHO, which is Schwab short-term US treasury, it's only 5%, and the other 5% will be on BIL, which is Spider Bloomberg 1 to 3 months T-bill, which is very short, and do that they went with the 50% of the portfolio will be this one. So we can go on Yahoo Finance and look at these ETFs, what percentage they offer, because we know we're going 10%, but these ones they don't offer 10%. So if you were to go and buy these individually, you will never get 10%. You will only get about 3%. It's look TLT. This is the share 20 year plus treasury bond. Look at the yield is only 2.33, and year to date is down about 3%, and expense ratio is only 15, right? So it's not it's very cheap. And we look at the other ones. This one will constitute about 30% of your portfolio, which is Vanguard Long Term Treasury Index Fund, VGLT. The yield here is only 3.19. Expense ratio is only 0.04. Year to date is about 2.68 minus. So let's look at the third one, which is Vanguard Intermediate Term Treasury Index, which this will constitute about 10% of the portfolio. This yield is only about 2.39%, right? And also its expense ratio is about only 0.04. Now, if you look at the fourth one, which is only 5%, is a short-term U.S. Treasury ETF. The yield here is only 2.98. And of course, expense ratio is 0.03. Year to date has returned about 162%. So that's a pretty good, because if you have a 1 point something on the bond and plus that one, there'll be 4% on annually, which is a pretty good for bond. We'll look at the last one will be Spider Bloomberg 1 to 3 months T-bill. This offers about 3.80. That is a pretty good. Has a high yield, even though it's short bond, but it has a high yield, which is a really interesting. Has the highest, right? And we look at the year to date. Look at that, it's 3.26. So it's really interesting. And expense ratio. This one has a little bit more when it comes to expense management ratio, or MER. Is a little bit more. It's about 1.14. So it's a little bit more risk, and it's more. Look at the graph here. So it's very volatile, this one actually, and that's why I think they offer that 3.8 yield. So that there you have. These are the ETF that they are going to invest, and we've seen those ones. We look at the fund details, right? Hamilton are available for purchase on Toronto Stock Exchange, which is a TSX, and can be used in RSP, REF, FHS, RESP, TFSA, portfolio, and also taxable account as well. To set up a DRIP, please contact your individual brokerage. So if you want to invest in DRIP, which is a dividend investment plan, when you get dividend, you just use those dividends to buy you more funds or more units. Then you can call your brokerage, Questrade, Simple, and they can roll you in that program, and you can get those ones commission free, which is a strategy I don't really recommend to use. I personally never use a strategy. I don't like it. I like to get my cash, and then I can use my cash whatever I please. We look at the ticker symbol again. Is HBND exchange, where it's going to be traded. It's going to be on Toronto Stock Exchange. Inception date to be announced, which is going to be on Friday, next Friday, on the 15th. Investment style will be fixed income cover call strategy. Initial target is 10% plus. So it depends on what's the market price of that bond will fluctuate to see how much is going up or down. But its initial is 10%, so I'm hoping it's just going to be 10% and up. We look at the distribution. It's going to be monthly, same as any other Hamilton ETFs. Currency hedging is 100% hedged to your Canadian dollars, and we look at the management fee is only 0.45. Why this is important? Because if we look at other Hamilton ETF, they've used a little bit higher. Let's look at, for example, HMAX here. This is HMAX. HMAX is more popular. HMAX and any other of their ETFs, actually, the MER, the management fee is about 0.65. So this one is 0.45. So it's about 20 0.2 basis point, 0.20 basis point. That's a lot, right? So that's a really great to see this. And this is because, of course, most of these fund they investing in their US based ETFs, and you look at the MER they have here, it's very low, right? It's very cheap, and that's why they were able to knock off this one from 65 compared to the other ETFs versus this one. Risk rating, of course, is low to medium, and yeah, so this is the fund. I'm really excited that they have this in the market, and and when it's coming on Friday. When it goes live, I will make a video to see how it trades and what's the changes, and any update on that will come next week when this fund is available on the market. But we know for sure it's coming on the September 15th, and it's going to have 10% yield, and it's already been approved, and they're going to use one of the most popular US treasury ETFs, from Vanguard, from iShare, from Schwab, and from Bloomberg. So there you have it for this particular ETF. And if you want to watch my other video I made on the other ETF that are coming soon, just click the link up here and you'll be able to see. And also I'm going to make a video comparing this particular ETF and other type of ETFs that are almost similar to this one. So again, if it's your first time, just make sure you subscribe, and if you like my video and my content, just make sure you give me a thumb up. And if you'd like, I would like you to share this video to the people that you think is going to help. Thank you very much. Till we meet again on next investing video. Bye bye.